how to research stocks before investing. More importantly, how do you know that you're not wasting your time researching into a company? Hey, what is up everyone, it's David here. What grinds my gears early in my investing journey is that I will spend all this time researching a company just to realize towards the end that the company is so overvalued, there is no opportunity here. Now, when it comes to money, we can get that back. That's not a problem. But when it comes to time, we can't get that back. So if you value your time and want to learn how to research a company quickly, then you want to watch this video all the way to the end. I've simplified my research process down to a checklist, and all of the free tools I used in this video are included in the description box below. If you learned something new, it will mean the world to me if you could gently smash the like button somewhere around here. And as usual, this video is not financial advice or recommendation to do anything. I happen to be a random Asian dude that popped up on your YouTube feed. So without further ado, let's go! Before I talk about the research process, I want to bust two myths because those two things keeps coming up whenever we talk about how to research stocks. So the first myth is investing within your circle of competence. The principle is sound from the perspective of it's way easier to lose money if you have no idea what it is that you're investing in. But the truth is, we also don't live in a world where information is only accessible via books. Internet gave us something really powerful. It gave us the ability to learn really quickly. Of course, you still need to put in the work, but instead of taking months or years to be somewhat adequate in a topic, YouTube videos and blog content will accelerate that journey into days or weeks. At the same time, it really depends on how hard that topic really is. For me, this sounds really controversial, but I don't want to box myself in just because of this idea of investing in your circle of competence. So instead of investing within my circle of competence, I invest within my circle of interest because I know that if I am genuinely interested on a topic, that will ultimately become my circle of competence. As a retail investor, we don't have to abide by any of these rules. We get to choose how we want to invest, how we want to research. It's really up to us. The second myth I want to bust is that high PE is bad. Well, it's not always bad, it's all relative and it really depends on the company growth rate. So let me show you what I mean by that. A really good example on why high PE is not always bad is to look at Amazon. Now this tool is called Ticker. It's a free tool that I use for my investing journey. I've included a link in the description box below and I'm not sponsored. So what we want to do is go to the valuation tab, go to next 12-month price to normalized earnings. So this is basically forward earnings. Click on it so that it will chart the graph. We'll look at a 5-year basis. You can see that on a 5-year basis, on average, Amazon trades at approximately a forward PE of 100. And if you compare Amazon with other companies, this is a relatively high PE. But if we were to put this in context, currently is trading at around 55 to around 60 forward PE. But if we go to estimates, which is basically analyst estimates to what they'll earn in 2021 and 2022, you can see that Amazon, which is a $1 trillion market cap company, found ways to grow their top line revenue between 25 to 30%. There isn't that many companies on earth that can do such a thing. So this is one of the reasons why it's not going to be very often to find Amazon at a relatively cheap PE. And just for your information, the last time that Amazon traded at a forward PE lower than 50 was after the GFC. Since then, there was not that many opportunities that it traded even below 50. We have to put things in context and understand that some companies who are really high quality and keep growing at a high double digits, the market is going to command a premium for them. So it's not very often you're going to find them at a cheap PE. Now that we've got the myths out of the way, there are two main components to my research process. You have the quantitative part, which is all about numbers, and then you have the qualitative part, which is about management team, the product, all that good stuff in detail. I used to start my research process with the qualitative research. But the problem with that is, what if I spent all this time understanding the product, the company, just to realize that the company is overvalued and there isn't an opportunity for this stock pick. So what I found to be way more productive is actually start off with the numbers to see if there is enough incentive or opportunity for us to invest more time doing qualitative research. Because at the end of the day, when it comes to money, we can get that back in the future, but when it comes to time, we can't get that back. So let's start off with numbers, and I'm going to use AMD as an example because, well, technically, I'm not trained as an electrical engineer, which makes me investing outside of my circle of competence. And this is actually a personal pick for me, so it's easier for me to share this example. So the first thing I like to do is come to FinWiz, put in my ticker, and go to this section right here, which is basically institutional price target on the company. And what I'm trying to gauge is just whether there is some kind of incentive for me to keep going, because I don't want to waste my time. And at the time of researching the company, AMD was trading at between 45 to around 49 bucks, and the price target was anywhere between 65 to 75. It wasn't close to 100 just yet. So I take the price target with a grain of salt. I just want to make sure I prioritize my time the right way. Now, in saying that, FinWiz is a free platform, but it only works for US stocks. So any company outside of US, just jump to step 3. What I like to do next, which is optional, is to come to tip ranks and look at the number of analysts covering the company. Because if there are no analysts covering the company, either this company is undiscovered or there is no institutional interest. And from my perspective, ultimately, it is the institutions that move the prices for these companies. Of course, when we become more seasoned investors, no analyst covering a particular company and negative sentiment can actually make a great opportunity. But we will revisit that in a separate video in the future. Then after that, I like to wrap up the numbers side of things by doing a very simple discounted cash flow model, just to make sure I am not wasting my time doing qualitative research just to realize there isn't an opportunity with this company. The whole point of this template is to take into account a range of growth assumptions with a range of probabilities to see if there is some kind of expected return for the company in the future. This template is public. You can feel free to try it out yourself in the description box below. But in order to keep things very simple, there are a few limitations I want to quickly point out. The tax rate is not dynamic and the discount rate is not precise. And what I mean by that is we are essentially guessing that because AMD is more risky to Intel, we are going to give it a higher discount rate, like for example 8% compared to 6% for Intel. On top of that, we are not taking into account share dilution, which I will fix in a future version of this template. I try to keep this very simple just so that it's not daunting to learn about valuation. So let's quickly go through this example together just so that you can see how I got my numbers and how I thought through it. I already explained the discount rate. And when it comes to perpetual growth rate, the idea here is that after 5 years, because this template only accounts for 5 years of projections, how fast do you think AMD will grow by? And generally, people put the country GDP in here. But personally speaking, I actually think that AMD will grow much faster than that. I really want to put a 5 or 6% perpetual growth rate, but this is where I built in my margin of safety and put in a 4%. I really don't like putting a margin of safety towards the end where I calculate the intrinsic value and basically slap on a 50% discount. So I will prefer to build in margin of safety throughout our assumptions. With EV/EBITDA multiple, what we will do is go to ticker, go to the company, go to valuation, and we will go to next 12-month EV/EBITDA. Click on that so then it will chart the graph. Stretch it to 5 years so that we can see the mean for next 12-month EV/EBITDA. It's around 30 times, so that's what I put. Now, transaction date is whatever that date is when you're making this model. Fiscal year end is basically the end reporting period for that company. Current share price, just put whatever the current share price is at the time when you start doing research, and then the rest should be automatic. The one thing I will say is double check the shares outstanding because sometimes that can be wrong. And we'll go to overview and then look at share outstanding. It's 1.2 billion shares, and that makes sense. Okay, cool. So step 2 is finding these items in these financial statements. Very, very straightforward. Just make sure that you don't include the extra zeros in millions because I've already taken into account those. And then step 3 is making growth assumptions about operating cash flow and EBITDA. Now, the one other thing I will say when it comes to the limitation for this template is that I express CapEx as a percentage to operating cash flow. Generally, it's a percentage of revenue, not a percentage of operating cash flow. But for simplicity's sake, this is enough to get us going. But to get the growth rate, we will go back to ticker, go to estimates, and then we will look at EBITDA first because we are already here. So you can see that 5 years actual and 2 years estimated, the compounded annual growth rate for EBITDA is around 89%. So this is where we're going to start building in our margin of safety. I don't think that they can keep growing at 89% or probably slow down. And I think a more reasonable figure is anywhere between 35 to around 40%, just because this is still a growth company. But to make sure that we are conservative with our growth assumptions, I have put 40% EBITDA growth rate for a bull case, a 35% base case, and then 30% for bear case. Relatively reasonable, I believe. Then if we scroll down and look at operating cash flow, you can see that the compounded annual growth rate is around 80%. That is, again, way too high. So I did the same thing as EBITDA. Really optimistic scenario with the bull case at 40%, base case 35, bear case 25. To get capex as a percentage to operating cash flow, just use this number divided by this and you should get a percentage, and you want to do it for 2020, 2021 and 2022 and get a reasonable assumption on what that percentage might look like. Now I put 15% here, and I'm going to get rid of the CAGR over here because it's not a growth rate, but it's just a capex as a percentage to operating cash flow. One of the main reasons why AMD have such a low capital expenditure is because they don't do their own manufacturing when it comes to the chips. TSMC does most of their manufacturing. So that's one of the main reasons why capex is so low. Last step is to assign probabilities to bear, base, and bull case. Now, because we were already pretty bearish with some of our growth assumptions, it's less likely that will happen. So I gave it a 10% chance. It's more likely the base case will happen because we were already pretty conservative with our most optimistic assumptions with growth. So I gave a 20% chance to bull case and a 70% chance to base case. So taking into account the probabilities and the upsides, the expected return over 5 years is around 48%. Personally speaking, if the expected return is lower than 40%, I am not going to proceed on the basis that there isn't enough incentive for me to do qualitative research. So I'll probably come back to this company another time. Because there is enough incentive, let's move on to the qualitative part of the research process. With my qualitative research, there are 3 main parts. First, we want to understand the product and also what is the competitive advantage of the company in the marketplace. Now, secondly, what is the quality of the management team, especially the person at the helm? Because a great CEO will be the differentiating factor between a great company that you have on your hands than a mediocre company. And 3, what is the employee satisfaction like in the company? Because a great company is a team sport. When it comes to understanding the product, especially consumer products, what I found to be really helpful is to actually try the product yourself. Then YouTube product reviews are also really good, not to mention Reddit reviews. I personally love Reddit reviews because they are so much more honest compared to the reviews you find on other places. And what you're ultimately looking for with product reviews is whether the customers love the product so much that it keeps going out of stock. That's usually a very good sign. But for enterprise products or pharmaceuticals, it's unlikely we can try them. So medical journals or even review sites tends to be really good resources to understand those. On top of that, a company will have a range of products for different use cases. So I actually like to rinse and repeat the process for all of the key products in the company. The question is, how do you know which product is a focus? How do you know which one is key to the business? And the way to find out is via investor presentations. My personal principle is that if it's not important enough for the product to end up on investor presentations, then it's not important enough at the moment. For AMD, the focus was on high performance hardware, especially in the Ryzen series of CPUs for both PCs and laptops. And they were doing that while trying to establish a presence with server hardware and also GPUs with the Radeon series. And as you dig deeper into the evolution of the product range, you actually realize where the competitive lies in the marketplace. And for AMD, even though they do have a much better product now, it really started because of their CEO, Dr. Lisa Su. And that brings us to the next step in the qualitative research, and that's the management team. When it comes to the quality of a management team, it's really dependent on the CEO. Because if you have a great CEO at the top, they tend to attract great people, and then the rest of the management team tends to sort itself out. So my checkboxes for a great CEO is if they're in a complex industry, like for example, semiconductors, electric vehicle, pharmaceuticals, then I much prefer them to have deeper expertise in that relevant field. Because ultimately, their decision-making will be more closely tied with having a great product for their customers instead of great metrics for Wall Street. And the second checkbox is that they need to have skin in the game. Having skin in the game, especially a higher ownership percentage in the company, means that they will make decisions for the best of the company, because if they make crappy decisions, that will impact their net worth. What became obvious to me when I was researching AMD is that Dr. Lisa Su had really deep semiconductor experience, and her PhD thesis was on semiconductors. But Intel at the time was led by Bob Swan, and he just didn't have the deep expertise in semiconductors compared to Dr. Lisa Su. And I personally believe that was a contributing factor to why Intel had a very turbulent internal environment and couldn't create a great product for customers. The last part to my qualitative research process is employee satisfaction. Because at the end of the day, even if you have a great CEO, you need a great team to help you bring that vision to life. And if you don't have great employee satisfaction, it's going to be very hard to attract talent. I think Glassdoor is by far the best platform for this. And what I like to do is, the first thing I like to check out is the general rating on Glassdoor over time. And an uptrend is indicating a better employee satisfaction. And what I like to focus on after that is the negative reviews, because the positive reviews can be manufactured. And I want to see if there's any common trends with, why are people unsatisfied in AMD, and if they have addressed some of the issues that's being said. So looking at some of the negative review, this really isn't a negative review just because it gave a 3-star rating and still approve of the CEO, still approve of the business outlook, and still recommends. So we'll look at some other ones. Now you can see that this one is pretty unhappy about the business, doesn't approve of the CEO, doesn't recommend, and it actually goes into detail. I'm not going to go through it, but you can go through that in your own time. And you can see that there's a general sentiment of just being unhappy in the workplace. And this actually repeats itself multiple times in 2008 and definitely 2012 as well. Yeah, just more of these ratings over time. And I think that since Dr. Lisa Su have taken over, a lot of those problems have been solved. What I also like to do is look at competitors' Glassdoor ratings and see how they stack up against AMD. Now, it was not 4.1 when I was researching this. It was actually lower than that because of the previous CEO. Nothing against him, it just Intel had a really tough time. But you can see that since Pat have rejoined the business, that rating have basically improved over time, and that's a really good sign. Pat, for many of you who may or may not know, he was an OG for Intel. He was one of the first ever CTOs. And this era was one of the best eras for Intel, absolutely. And before he actually rejoined Intel, he was one of the better CEOs in VMware. So having him come back to Intel was an absolute confident boost for Intel investors. After all of that research, you can go back to the DCF template, make any changes you see fit, and it's time for you to decide how you want to allocate capital to that company. I don't have a checklist for that because that really depends on your circumstances and your risk tolerance. But I've created a full checklist for the research process together with all of the free tools I used in this video in the description box below. So feel free to help yourself or share it with a friend. The next logical question is, when should you sell? I've made a dedicated video for that, so feel free to check out that video after this one. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very soon.